Bloomberg Audio Studios. Podcasts, radio, news.
So markets got very oversold last week with the S&P touching correction territory. That's from Morgan Stanley saying, quote, "We don't think investors should view a relief rally from oversold levels as a sign that volatility is subsiding in a durable manner. The speed and uncertainty around the new policy introduction is denting investor, consumer, and corporate confidence." For more on this note, the author himself, Mike Wilson, Chief Investment Officer over at Morgan Stanley. So where are we right now within the market?
So good afternoon, and thanks for having me on. I think so far the markets have played out, I guess, the way we thought they might have, which is that the growth expectations are coming down for all the reasons you mentioned, in addition to the fact that we had, kind of a euphoric state at the end of last year. The Fed stopped cutting interest rates in December, and we have this sort of questions around, the sustainability of AI CapEx, growth acceleration. So the market had to absorb all these different things, and they're all pretty much growth negative in the short term. And that's how we saw it kind of playing out this year. That's 5,500. That was the low end of our range. We got there. Now the question, Alex, as we're kind of going through is, we don't really know yet how this is going to play through into the second and third quarter. So I think it's about time now. Maybe we don't have to take out 5,500. Maybe we do, depending on if the government recession, if you want to call it a government recession, turns into something more broad across the broader economy. And then, of course, the Fed yesterday, kind of showed their hand, I would say. They reduced the balance sheet reduction by $20 billion a month. That was unexpected. There was also some concern they might take a hike out of their dot plot. They didn't do that. So as we wrote last week, we think, maybe there's not a Trump put here, as people were kind of hoping for, but the Fed is still there. Mm-hmm. And if we do have, worse growth outcome, I think the Fed will react pretty quickly like last fall.
So when you mentioned waiting for the good side, right, we tend to think we just got to get past April 2nd. Is it actually going to be later in the year? We actually have to get to tax cuts and deregulation and what that looks like before anything can really be solved?
Yeah, I would suspect that, earnings revision breadth, and that's something we track closely, as well as maybe economic surprises, maybe don't start to turn up until, the fourth quarter. And in fact, the administration is sort of even targeting that. But remember, stocks are forward thinking. So it doesn't mean that stocks have to languish all the way until the fourth quarter. We could see things start to, probably trough out either now in certain circumstances where stocks have really been hit hard, or it may take until the summer or the fall. But it's going to be kind of, remember we had a rolling correction. This is going to be a rolling recovery, is my best guess.
Okay, a rolling recovery where you see some so-called low-quality stocks driving this short-term rally. What constitutes a low-quality stock, Mike?
Well, I mean, bad balance sheet, too much leverage, low margins, not that profitable. So those are the kinds of stocks that tend to do the best when it's sort of a relief rally. Mm-hmm. So we're not advocating that those should be core positions, but that, if in fact it is a low quality rally kind of leading us for the next week or two, that will just inform us that we probably have more, wood to chop in terms of the broader market finding its footing and being able to make a march towards new highs. We think new highs are probably out of the question in the first half of this year. Okay. But by the second half, it's very plausible as we look forward to 2026.
In the meantime, we've seen the dollar come off its heights, too, from mid-January. It's lost a lot of ground recently. At some point, that recent dollar weakness will help earnings for a lot of the S&P 500 companies that rely on overseas sales, won't it?
That's exactly right. And that was one of our concerns coming into this year, is that the dollar was very high and rates were high. So now that's reversed, right? You have lower rates and you have a lower dollar. And quite frankly, this relative trade versus Europe, I think, could go the other way now as we go into earnings season. I mean, Europe benefited from the stronger dollar, into first quarter, period. And that was one of the big positive drivers for Europe. Now, as they report first quarter earnings, it could be the exact opposite. So that trade, that relative trade, we think has kind of gone fully. So I would advocate sort of S&P 500 over Europe now on a rebound trade that direction.
Oh, that's interesting. But then what about all the money that Germany's spending? Like, you think that doesn't hold enough water to really cycle through the market as much?
Well, Germany's up 17% this year, so I think you've discounted quite a bit of that. And once again, just in the very near term, this is more tactically speaking, that the revision factors for Europe should look weaker relative to the U.S. just based on that currency factor that Scarlet was asking about.
When you take a look at the NASDAQ and Mag 7, say in particular, is that sort of its own beast in essence? Because there was that euphoria and that was, you can make an argument, an overvaluation. Is that a little different from what the rest of the market has to sort of manage right now with that headline risk?
Well, it's interesting you bring up Mag 7 because that too is a situation where the earnings revisions have rolled over harder than the rest of the market, and that's why that group is underperformed. But we're starting to notice now in our data, we look at this daily, that's flattening out now, and that may actually pick up. And remember, the Mag 7 will benefit from that weaker dollar feature. So I think that there may be a trade there as well to maybe kind of buy back into the Mag 7 relative to the 493 or kind of the equal weight where, that we've seen pretty significant underperformance over the last couple of months.
So we have this rally, a recovery rally, but it's not a durable rally as you've seen. That suggests that there's more downside ahead. Do you anticipate next time around that there's going to be more forced selling? I don't get the sense that we got that this last time. And so as a result, we didn't really reach capitulation.
Well, I don't know about that. We got as oversold as we saw during 2022, and we did see some forced selling from some of the systematic strategies and some of the more levered players out there for sure. We definitely didn't see forced selling in the retail community, but we may not see that. The retail community, has made a lot of money the last few years, and they have a lot of cash on the sidelines, so maybe they're in better shape. They don't get to that position. What we're looking for, quite frankly, is not so much technical. It's more on the revision side. We need to see earnings revisions stabilize and then start to turn up again for this to become a rally that can lead to new highs. When I say it's not a durable rally, it doesn't mean we have to go lower. It just means we're going to chop around.
Yes.
And that's a difficult environment. It's a trading environment, and it's fine if you're a trader, but as an investor, it's going to be noisy. And so you don't need to be rash here thinking you're missing something either way. It is a trading environment. Vol's going to stay high, as we said, and we think it will work its way through over the next 2 quarters, and by the second half of the year, we should see better visibility on 26 growth getting better.
So, Mike, which sectors would you want to be in as sectors that may give guidance that, moves to the upside?
So I think, we've been very focused on 4 sectors where the revisions have been quite good. That's financial, software, media, entertainment, and some of the consumer services sectors. Some of those are starting to flatten out a little bit, and then we've seen relative strength now lately in the defensive sectors, most notably utilities and some of the staples areas, not on revisions, but on price. So I think the barbell sort of between those 4 sectors I mentioned where revisions are good and a little bit of defensiveness in the portfolio still makes sense probably going into the second quarter.
All right. Really a pleasure to have you on, Mike. So thank you so much for joining us today. Mike Wilson over at Morgan Stanley talking about this tradable rally, a choppy rally here around the 5,500 level.